The Federal Reserve made a big decision. It cut interest rates. This was unexpected. The financial community was taken by surprise, as many had anticipated a more cautious approach. The decision was made in response to growing concerns about the economy's health. The Fed hadn't done this in years. In fact, it had been a significant period since the last rate cut, marking a notable shift in monetary policy. Historically, such decisions are not made lightly and often signal deeper underlying issues within the economy. The move sent ripples through the financial world. Stock markets reacted almost immediately, with traders scrambling to adjust their positions. Financial news outlets buzzed with analysis and speculation, trying to make sense of the Fed's unexpected move. Why did they do it? Analysts and economists began to dissect the decision, offering various theories. Some believed it was a preemptive measure to stave off a potential downturn, while others thought it was a response to specific economic indicators showing signs of weakness. The economy is showing signs of slowing down. Retail sales have been sluggish, and there are increasing reports of businesses struggling to maintain profitability. These signs point to a broader economic malaise that could worsen if not addressed. Inflation is also a concern. While inflation rates have been relatively stable, there are fears that they could rise if the economy doesn't pick up. The cost of living is a critical factor for many households, and any increase in inflation could have widespread effects. The Fed hopes this rate cut will stimulate growth. By lowering interest rates, they aim to make borrowing cheaper, encouraging businesses to invest and consumers to spend. This, in turn, could help to kickstart economic activity and prevent a deeper downturn. They want to prevent a recession. The specter of a recession looms large, and the Fed's move is seen as an attempt to avert such an outcome. A recession could have severe consequences, including higher unemployment and reduced consumer spending. This decision is a gamble. There are no guarantees that the rate cut will have the desired effect. It's a calculated risk, with the Fed betting that the benefits will outweigh the potential downsides. It could boost the economy. If successful, the rate cut could lead to increased investment, job creation, and overall economic growth. Businesses might expand, and consumer confidence could rise, leading to a virtuous cycle of economic improvement. Or it could backfire and cause more problems. There's always the risk that the move could lead to unintended consequences, such as asset bubbles or increased financial instability. If the rate cut fails to stimulate the economy, it could exacerbate existing issues. Only time will tell what the ultimate impact will be. The coming months will be crucial in determining whether the Fed's decision was the right one. As the economy responds, we'll gain a clearer picture of the effectiveness of this surprising move. The stock market loved the news. Major indices like the S&P 500 and Dow Jones surged. Investors were clearly happy with the Fed's move. They see it as a sign of confidence in the economy. Treasury yields also reacted. They went up. This means investors are demanding higher returns on government bonds. They're a bit worried about inflation. The market's reaction was immediate and strong. It shows how closely people watch the Fed. Every decision they make has huge implications. So, who benefits from this rate cut? Borrowers are big winners. Lower interest rates mean cheaper loans. This is good for businesses and consumers looking to borrow money. Investors in stocks also stand to gain. A growing economy usually means higher corporate profits. This can lead to stock price increases, but there are losers too. Savers will see lower returns on their deposits. Retirees relying on fixed income investments will also feel the pinch. This isn't the first time the Fed has cut rates. It's a tool they've used before in times of economic uncertainty. Sometimes it works, sometimes it doesn't. History shows mixed results. There have been times when rate cuts successfully boosted the economy. But there have also been times when they led to inflation. The Fed is walking a tightrope. They need to find the right balance between stimulating growth and controlling inflation. It's a delicate dance. Section 5. Diversification is key. What does this mean for your investments? Well, it's a good time to review your portfolio. Make sure it's diversified. Don't put all your eggs in one basket. Consider a mix of stocks, bonds, and other assets. This can help protect you from market volatility. It's all about managing risk. And hey, if you're unsure, talk to a financial advisor. They can help you create a plan that meets your individual needs and goals. Section 6. The bond market. A safe haven. Bonds are often seen as a safe haven during times of uncertainty. But with interest rates so low, their appeal is diminishing. Investors are seeking higher returns elsewhere. However, bonds still play an important role in a diversified portfolio. They provide stability and can offset losses in other asset classes. It's important to choose your bonds carefully. Consider the duration and credit quality. Section 7. Expert opinions, a divided landscape. In the world of finance, opinions are often as varied as the markets themselves. Today, we delve into the divided landscape of expert opinions regarding the Federal Reserve's recent decision. Experts are divided on the Fed's decision. Some applaud the move, seeing it as a necessary step to stabilize the economy. They argue that the Fed's intervention was crucial to prevent a looming recession, which could have had devastating effects on businesses and individuals alike. These proponents believe that the rate cut was essential to maintain consumer confidence and encourage spending. They point to historical data showing that timely interventions can mitigate economic downturns. However, not everyone shares this optimistic view. On the other side of the debate, some experts are more cautious. They worry about the long-term consequences of such a decision. These skeptics argue that while short-term gains might be achieved, the potential for creating economic imbalances is significant. Some economists argue that the rate cut was premature. They believe that the economy, despite facing challenges, remains fundamentally strong. They caution that lowering rates too soon could lead to unintended consequences, such as inflation or asset bubbles. These experts highlight that the economy has shown resilience in the past and that a more measured approach might have been wiser. They fear that the Fed's actions could create artificial growth, leading to unsustainable economic conditions. One of the primary concerns is the creation of asset bubbles. When interest rates are low, borrowing becomes cheaper, which can lead to excessive investment in certain sectors, such as real estate or the stock market. This can inflate prices beyond their true value, creating bubbles that could burst with severe consequences. Others believe the Fed waited too long to act. They argue that the signs of economic slowdown were evident for months, and a more proactive approach could have mitigated some of the current challenges. These experts call for more aggressive measures to stimulate the economy. They say the economy is already slowing down, with key indicators showing signs of distress. They believe that without decisive action, the situation could deteriorate further, leading to higher unemployment and reduced economic activity. In conclusion, the debate among experts highlights the complexity of economic decision-making. While some advocate for immediate intervention to prevent a recession, others caution against hasty actions that could have long-term repercussions. The divided landscape of opinions underscores the challenges faced by policymakers in navigating the delicate balance of economic stability. Section 8. Jerome Powell speaks. Jerome Powell, the chairman of the Federal Reserve, addressed the public after the rate cut. He explained the reasoning behind the decision. He emphasized that the Fed is committed to supporting the economy. Powell acknowledged the risks of inflation, but he said the Fed is prepared to act if necessary. He reassured the public that the Fed is closely monitoring the situation. His words were carefully chosen. He tried to strike a balance between confidence and caution. Section 9. The inflation equation. Inflation is a major concern for the Fed. It's a rise in the general price level of goods and services. When inflation is high, your money buys less. The Fed aims for a target inflation rate of 2%. They believe this is healthy for the economy, but inflation has been stubbornly low in recent years. The rate cut could potentially push inflation higher. This is because it makes borrowing cheaper. This can lead to increased spending and demand. Section 10. What's next for the Fed? The Fed's decision to cut rates is just the beginning. They will continue to monitor the economy closely. They are prepared to adjust their course if necessary. Future rate cuts are possible, but it all depends on the data. The Fed will be watching inflation, employment, and other economic indicators. Their next move is uncertain. But one thing is for sure, the Fed will do whatever it takes to keep the economy on track. Section 11. Navigating uncertain waters. In life, we often find ourselves sailing through rough seas, especially when it comes to our finances. The economic landscape can be as unpredictable as the ocean, with waves of uncertainty crashing against our plans. We live in uncertain economic times. The future is unpredictable. Businesses close, markets fluctuate, and the financial stability we once took for granted can seem like a distant memory. It's easy to feel overwhelmed and anxious when faced with such volatility. But there are things you can do to protect yourself. Start by organizing your financial documents and having open discussions with your family about your financial situation. Seek advice from a trusted financial advisor who can help you navigate these choppy waters. Stay informed about the economy. Read financial news, follow expert commentary. Knowledge is power, and staying updated with the latest economic trends and insights can help you make informed decisions. Use reliable sources and diversify your information channels. The more you know, the better prepared you'll be. Don't panic. Market volatility is normal. It's important to remain calm and composed. Remember, even seasoned investors experience market fluctuations. Meditation and mindfulness can help maintain your mental equilibrium. Don't make rash decisions based on fear or emotion. It's tempting to react impulsively when the market takes a downturn, but hasty decisions can lead to greater losses. Take a step back, breathe, and think through your actions carefully. Stick to your long-term investment plan. Review your goals and ensure your investments align with them. Long-term planning can provide a sense of direction and stability, even when the market is turbulent. Consult with your advisor regularly to stay on track. Remember, this too shall pass. Economic downturns are temporary. Draw inspiration from motivational quotes and speakers who remind us of the resilience of the human spirit. Just as the sun sets, it will rise again, bringing new opportunities. The economy goes through cycles. Understanding these cycles can help you anticipate changes and prepare accordingly. History shows that after every downturn, there is an upturn. Educate yourself on economic patterns and trends. There will be ups and downs. Just like a roller coaster, the market has its highs and lows. Embrace the journey and stay focused on your long-term goals. The ride may be bumpy, but perseverance and patience are key. But over time, the market tends to rise. Historical data shows that despite short-term fluctuations, the market generally trends upward over the long term. Stay committed to your investment strategy and trust in the process. Your patience will be rewarded.